Coming up on today's program, South African Reserve Bank's MPC cuts lending rate by 50 basis points. Rwanda's GDP growth to slow to 2% this year due to coronavirus. And Egypt sells $5 billion in 3 tranches of bonds. Thanks for joining us on Business Incorporated. I am BC Adebayo. Let's begin the show with intraday market numbers from major markets in Africa. In South Africa, the JSE continued its negative trend and declined 2.24% rather, while the NSE here in Nigeria rose 0.92% at intraday. In Egypt, the stock market closed the week negative on Thursday by 0.94%, and that was in response to the country's slower growth rate and poor quarterly profits reported by investment bank EFG Hermes. Kenya closed negative on Thursday as well. And major Gulf markets closed the week mostly positive on Thursday ahead of the Eid holidays that start on Sunday. Dubai's index was 0.28% up as Emirates NBD Bank gained 0.6%, while Dubai's financial market rose 2.7% after its quarterly profit jumped 23.5%. On the flip side, Abu Dhabi's index was the sole loser by 0.43%. Elsewhere in the region, the Qatari index rose 0.19%, while Saudi Arabia's index was flat at 0.01%. And in Europe, stocks traded low on Friday as ties between the U.S. and China come under further strain, potentially threatening the Phase 1 trade deal signed earlier this year. Let's bring in Chelsea Delaney at the Frankfurt Stock Exchange for more from the European scene. Good afternoon, Chelsea. So China has announced plans to strengthen its power in semi-autonomous territory, Hong Kong, reigniting geopolitical tensions over China's influence. How did investors in Europe react to all of this?
Well, markets here in Europe started the day down quite a bit. The DAX here in Frankfurt opened down about 1.5%, but we have seen investors increasingly brushing these tensions off, and the index has reclaimed most of its losses. Nevertheless, it still is a major concern for investors. The latest salvo in this tit for tat between the United States and China it came overnight when China basically decided that it would present plans to exert more authority over Hong Kong, and the United States has hit back and said that they could sanction both individuals and financial institutions that support this aim. So that's been a big concern. We did see bank stocks in particular get hit pretty hard as a lot of investors worry that these big global banks that have a big presence in Hong Kong could face sanctions over their work there. This also is coming as what really for a long time was just a trade war between the U.S. and China is really broadening out and taking on a lot of different issues. So now the U.S. and China are fighting over all sorts of different issues now. The response to coronavirus, the handling of tech, pharmaceuticals, and now these changes in independence in Hong Kong. And so investors certainly are having to price back in the risk of further escalation in tensions between the U.S. and China.
Politicians in Germany are calling for tax cuts for businesses and individuals to help bolster growth as the country falls deeper into recession. Does this proposal have a chance at success?
It's hard to tell at this point. There are a lot of different proposals floating around. Germany already has taken a lot of steps to help the economy recover from coronavirus, but they are expected in the next month or two to release a new stimulus package that would help businesses and individuals. And now we're seeing a lot of different proposals for this, and that is where we got these proposals for tax cuts. And this is something that comes up a lot with Germany because Germany has pretty high tax rates, especially for corporations, but for individuals as well. And many economists say that if Germany were to cut taxes, it would really help the economy rebound. But on the other side, Germany is now facing a tax shortfall because because of the coronavirus. So businesses aren't making as much money, they won't be paying as much in taxes, and they also have introduced some tax delays for businesses. So they're expected to lose about 300 billion euros between now and 2024 in tax revenue. So there are also politicians who say now is really not the time to be cutting taxes. It may be even the time to be raising taxes because to make up for that tax shortfall. So there's a lot of different proposals floating around for how to stimulate the economy. But we likely will see more discussion over this in the coming weeks as the government does prepare their next round of stimulus.
Absolutely, Chelsea. Now, let's talk about Facebook's plans to shift towards a more remote workforce over the next decade, of course, as the coronavirus reshapes work practices. What would more remote work mean for the broader economy?
Well, there are some specific things that are likely to be seen in these areas where tech companies are really prevalent. So if you think about Silicon Valley, where most of these big tech giants are based, Facebook, Twitter, things like that, they have had a really big impact on the economy of that area, and not always in a good way. So once Facebook and Google really started growing quite fast, real estate prices in the San Francisco area just skyrocketed, and it priced a lot of people out of that area. So it's become increasingly unaffordable in San Francisco. So that could be one result, is if they do allow more remote working, people might leave San Francisco, and that could bring down the real estate prices in that area. At the same time, it could also bring down tax revenue. It could really sap the local economy of revenue and of business for things like tailors, restaurants, retailers. So there would be likely mixed outcomes of that, but it also would it would impact the economy in different ways. And we've already seen this happening in the COVID era, where a lot of higher paid, higher skilled jobs can be done remotely. But many of the lower skilled jobs, things like working in a shop, working in a restaurant, those can't be done remotely. So we're also likely to see a divergence in what kind of work and what kind of businesses can be done remote in the future.
Fingers crossed, Chelsea. Thanks, and do have a great weekend. In the UK now, government borrowing hit its highest level on record last month amid the COVID-19 pandemic. Let's talk to Juliana Olayinka at our London studio for updates on this and more. Good afternoon, Juliana. The government borrowing surged by the highest monthly figure on record to £62 billion in April, and that's after heavy spending to ease the coronavirus crisis. How much more will the pandemic cost the UK? And tell us how the government actually plans to clear the deficit.
Good afternoon, Bissy. Gosh, it's going to cost the UK government hundreds of billions of pounds more. And as the economy is trying to recover, this monthly borrowing is likely to surge. I've got to say that this £60 billion a month is much higher than economists here had imagined. They put it down at about 50% lower, which would have been about 30 billion. In fact, that £61.2 billion is almost the entirety of the amount that they borrowed in the 2019-2020 tax year. Of course, all of this is about Chancellor Rishi Sunak propping up the economy with the government furlough scheme. What they're doing is they're subsidising employees' wages to the tune of 80%, and that's costing the government billions of pounds. Now, the government revenue here in the UK comes pretty much from three ways, and that's national insurance tax, VAT, and employment tax. And so with the furlough scheme, they're likely to get back a lot of that money because it's only a loan. Employers do have to pay that back, but there are concerns about VAT because at the moment, of course, people are not spending. Consumer confidence is really low, so there are concerns about that. But we did hear from the Chancellor at the back of this data released by the Office for National Statistics, and again, they did say that they're not worried about borrowing today, and they won't be worrying about that for the next couple of months. What they want to do is make sure that people are able to keep their jobs during this turbulent economic crisis. And of course, they do have the Bank of England who are completely supporting them, and they're buying back most of this heavy debt. At the moment, the debt stands at about 98% of GDP, which, as you said, is completely record-breaking and historical for Britain.
In company news now, luxury fashion chain Burberry has highlighted the slump in retail in Q1, of course, due to the COVID-19 pandemic. How badly did the virus affect the store's earnings?
Pretty badly, and it's been a turbulent couple of months for Burberry, not just Burberry, but for a lot of luxury retailers whose predominant base is in the Far East. That's where they get most of their coin, and that's where the market is pretty successful. First of all, they had those Hong Kong protests, which may or may not be on the rise again, and then it was COVID-19, which they couldn't ignore, and they had to shut down most of their stores. So they were first hit in Asia, and when the wave started coming to the global north, they had to shut down their stores in North America and Europe. So they have put down their Q4. Their Q4 end of year finishes at the end of March, and that's fallen by about 27%. But Burberry shares were actually up 2.5% this morning because shareholders are happy with the option that they've decided to take, which is to cancel their end of year dividend. They said they'll be reviewing their dividend for next year, but because they did that, they managed to save £120 million. In Q4, they lost over £245 million. But again, they managed to impress their shareholders by saying that in the month of April, their sales in Asia was better than it was this time last year. And of course, that matters because Asia is their main market. So it's pretty difficult for luxury retailers in Asia. Their main base, they're likely and they're looking forward to people going back into their stores.
But tell us how the markets are performing at this time, plus an outlook for next week.
Well, the FTSE is likely to go into the weekend into the red. It was down at the start of early trading. It's still down at intraday. Some of the biggest losses are coming from the Asia-focused blue chips. We are hearing that China may be imposing some new civil liberties laws in Hong Kong, and that's really starting to affect the markets because we do remember that just a couple of months ago, those protests in Hong Kong did turn violent and almost interrupted the trading in Hong Kong. So at intraday, the all share is down 0.89%. The FTSE 100 is down 0.97%, and the FTSE 250 is down 0.80%. In currencies, the pound is down on the US dollar by 0.34%, up on the euro by 0.08%, and down on the Japanese yen by 0.48%. Next week, it's a short week here in the UK, busy, because on Monday it's a bank holiday, so the markets will be closed. But I'm sure when we speak again on Tuesday, we're likely to talk about some more data that's been driven by the COVID-19 that's likely to affect the UK economy.
Yes, indeed, Juliana. So enjoy your very long weekend. We'll see you after the holiday.
Thank you, Bissy.
The stocks in Asia Pacific fell on Friday as rising tensions between the U.S. and China weighed on investor sentiment. Hong Kong's Hang Seng Index led the losses among the region's major markets as it plummeted 5.56% to close at 22,930.14. China plans to impose a new national security law in Hong Kong after months of anti-government protests in the Chinese-ruled city. Mainland China stocks also declined, with the Shanghai Composite down 1.89% and the Shenzhen Composite shed 2.22%. Elsewhere, the Nikkei 225 in Japan closed 0.8% lower, and the Topix Index ended its trading day 0.9% lower. In South Korea, the Kospi fell 1.41%, closing at 1,970.13, and shares in Australia also declined. Meanwhile, U.S. stocks fell today after a decline in some major tech stocks, along with dismal employment data and rising tensions with China, which pushed the market lower a day earlier. Dow Jones Industrial Average Futures implied a drop of about 170 points at the open. The S&P 500 and Nasdaq 100 futures also pointed to a negative open. The Dow fell just over 100 points on Thursday, while the S&P 500 and Nasdaq dropped 0.8% and nearly 1% respectively. Investors also fretted over U.S.-China trade tensions earlier in the week. The Senate passed a bill that would potentially delist Chinese stocks from U.S. exchanges. And crude oil prices slumped today after China's decision to omit an economic growth target for 2020 renewed concerns that the fallout from the coronavirus pandemic will continue to depress fuel demand in the world's second largest oil user. Brent crude fell 4.3% to $34.50 a barrel, while US WTI crude dropped 5.3% to $32.13 a barrel. China's National People's Congress kicked off a week-long meeting on Friday with the government saying it omitted the 2020 target while pledging to issue 1 trillion yuan of special treasury bonds to support companies and regions hit by the pandemic. Still, both Brent and WTI are heading for a fourth week of gains, and that's as more evidence emerged that fuel demand is recovering as countries ease business and social restrictions imposed to counter the coronavirus pandemic. When we return in just a moment, we'll head over to South Africa to drill down on the MPC's decision. Please stay with us. Welcome back. The Monetary Policy Committee of the South African Reserve Bank has cut the lending rate by 50 basis points to 3.75%, effective from May the 22nd, 2020. The cut is the third since the advent of COVID-19 in the country in March, when the MPC cut the repo rate by 100 basis points, and a second 100 basis point cut was announced in April. The SARB governor says even though the lockdown has been relaxed, investments, exports and imports are expected to decline sharply for the rest of the year. Let's talk to Trinity Nkube, an economic analyst in South Africa, to drill down on the MPC's decision and more. Good afternoon, Mr. Nkube. Thanks for joining us on the program. Tell us what you make of the MPC's decision to cut the rate by 50 basis points to 3.75%.
Good afternoon, and thank you for having me again. It was the right move. The economy is under life support, so we need everything that we can throw at the economy so that we can have a lifeline. So I fully support it. There's a lot of debate around economists in terms of, is this something that is feasible? Because, you know, with the monetary policy decisions, there is an impact lag of 18 to 24 months. However, at this point, it is one of the best things to do, you know, in tandem with the fiscal policy.
Now, this is the third cut since COVID-19 got into the country. Is it likely that there will be more cuts?
Absolutely. A lot of interest rates are going to be very low, I mean, globally. So I expect, you know, the South African Reserve Bank to keep on, you know, dropping some points, some basis points. To what level, I'm not quite sure. I don't think we'll get to a point where we have negative interest rates, but I expect a few of these cuts, at least 2 or 3 within this year.
Mr. Nkube, you probably agree that monetary policy without implementation of prudent macroeconomic policies and structural reforms cannot reduce fiscal risk or even improve the potential growth rate of an economy that is already in a recession, such as South Africa. What kind of reforms should the government actually be looking at this time?
You're absolutely right. When you look at South Africa, the main issue has always been structural reforms, particularly from the fiscal side. When you look at income inequality, all the inefficiencies and ineffectiveness when it comes to how the economy operates, you get the majority of South Africans who are not really chipping in or unable to take part into the, you know, in economic activity. Hence, yes, there's definitely a need for structural reform. One that comes to mind is the competition policy. We really need small, medium enterprises to be able to take part in this economy, mainly from the majority of Black South Africans, to be able to get into serious manufacturing, value addition, beneficiation, and all of that. That is what we'd like to see. If we just have the BEE as just a label, that is not going to work. So we definitely need reforms regarding more players coming into the country, into the economy, so we can have more active participants, so we can have a larger tech space.
What has been the effect of the COVID-19 pandemic on SMEs and the loss of the middle class so far?
It's been devastating. Right now, if the numbers serves me right, we have about 30%, a 30% decline in the number of vehicles being sold to the middle class. We also have 1 in every 5 middle class person renting properties being unable to pay rentals. This is on the residential properties. When you look at the commercial properties, the same is also going on. So once you start having the black middle class being wiped out almost completely, we're looking at almost 7 million jobs being lost between now and then. And right now, the South African Reserve Bank also has mentioned there's about 7%. I think about 10% of economic downturn from now up until post-COVID. So that is very devastating. The more that we have a lot of middle class people not being able to work and earning income, that is eroding the tax base, as well as a lot of unemployment. There's just a lot of stress across the economy. It's been very devastating, and hopefully these debt reliefs, as well as packages that are going to the unemployed and some of the small businesses, will do some damage control.
So do you have any projections for next week, even as we try to take some damage control, just as you mentioned?
Things are not looking great. I'm an optimistic person, as you have known me. We are looking at at least with the lockdown being relaxed, we're starting to have some people coming into work, as well as just getting some of those sectors in the economy starting to come, into improvement and all of that. So that is not going to really do much in terms of economic growth, the long-term economic growth path. However, it is going to set some relief in terms of people at least being able to get some income for consumption. But on the longer path, we will have to wait and see.
Many thanks, Mr. Trinity Nkube, economic analyst in South Africa. Thanks for coming on the program, and do have a great weekend.
You too. Thank you for having me.
Rwanda's economic growth is expected to slow to 2% this year from 9.4% in 2019 as the COVID-19 pandemic hits tourism, transport and hospitality. According to the finance minister, growth is expected to rebound next year to 6.3% and improve further to 8% in 2022. And Egypt has sold $5 billion in bonds in 3 tranches with maturities of 4, 12 and 30 years as the country grapples with the economic fallout of the coronavirus. The country sold $1.25 billion in 4-year notes at 5.75%, $1.75 billion in 12-year bonds at 7.62%, and $2 billion in 30-year notes at 8.87%. That deal attracted more than $6 billion in demand for the 4- and 12-year tranches each, and more than $7.6 billion for the 30-year bonds. And that's where we end today's program. Thank you for watching. I am Bisi Adebayo.